Now that you've had kind of a huge, brief overall view of the general accounting process, bookkeeping system, transaction analysis, all those different aspects as a reminder, let's talk about the presentation of current assets and accounting for those. In this specific chapter, you're going to cover these 10 different types of learning objectives. What is included in cash and cash equivalents as reported on the balance sheet? What are the key features of the internal controls and why are they important? We're going to talk about bank reconciliations, short-term marketable securities and how they're reported on the balance sheet, how accounts receivables are reported on the balance sheet, including the additional valuation allowances for cash discounts and uncollectible accounts. We're going to look at notes receivable and accrued interest and how they're reported on the balance sheet. Inventories. We'll do some discussions on some alternative inventory cost flow assumptions and look at their general respective effects on the income statement and the balance sheet as a result of different price levels changing. The impact of inventory errors on both the balance sheet and the income statement. And we're going to talk about why prepaid expenses are important, what they are, and how we report them on the balance sheet. We're going to go through quite a bit of information in this chapter related to current assets. Current assets are those assets that are expected to convert to cash or used up within 1 year or an operating cycle, whichever is longer. Some common current assets include cash, short-term securities, accounts receivables and notes receivables, deferred tax assets, prepaid expenses, and inventories. All of these are classified as current as they are expected to be consumed or used up within 1 year or the operating cycle. So let's start with the word cash. Cash really does actually mean a lot of different things. Cash itself includes the actual coins and the paper money that you have on site. It includes those little petty cash funds that may be in place. Receipts, so for example, checks that you have received but that you have not yet deposited. Money orders are considered cash. And the checking accounts of the organization are classified as cash, as are the savings accounts, as long as they're straight savings. Cash equivalents, though, are slightly a little bit different. These are assets that are expected to mature within 90 days. So most frequently, you will find that they are commercial paper, U.S. Treasury securities, bank certificates of deposit, and money market mutual funds. Money market mutual funds are often a way in which organizations will save money. So it functions very similar to a savings account, but they have a higher yield than the traditional savings account are because they are invested in short-term investments expected to convert relatively quickly back to cash. One of the reasons you really, as a manager, will always want to have a good familiarity with accounting information is cash management falls very squarely in the field of the manager. Effective cash management involves taking the excess cash of an organization and investing it with minimal risk. You have to ensure that there is an availability of adequate cash at the points in time in which they are needed. You don't want to have millions of dollars sitting in your checking account doing nothing. That is an unnecessarily large amount of idle cash potentially. So you want to take the amount of that is deemed unnecessarily large and convert it into other types of investments that will yield revenue. We want our money to earn as money. And if it's not going to be able to earn as money in operations, so in the conversion of raw goods into materials for sale, or as wages leading towards service revenue, then we want to put it to use otherwise. Another great way that cash management serves us is that it helps prevent some theft and fraud. Cash itself, so we're looking at, just money in the checking account or raw cash dollars, things of that nature, are very, very susceptible to theft and fraud. If we tie them up in a 90-day security or something else of that matter, there is less likelihood of theft and fraud associated with that amount. Doesn't mean it won't happen, it's just less likely. So you should have covered an entire chapter in your principles classes on internal controls. The basic internal control objectives are to ensure that there is efficient and effective operations, reliable financial reporting, compliance with the applicable laws and regulations, and the most susceptible area is cash. With cash, we're talking about an area of the organization that things are moving often. You're receiving money, you're sending money. The more transactions there are in account, the higher the likelihood of errors. And then, of course, the higher the likelihood there is of potential theft and or fraud. So some of the internal controls over cash. This is by no means an exhaustive list. This is something that should, in theory, be happening at every organization. Is that deposits are made daily. That payments are made by check. So when we are paying vendors, we're not paying them cash, we're paying them with a check. Creates a source document and a paper trail. And that the bank statements are reconciled promptly in order to uncover any errors, theft, or fraud that might be occurring in short time frame, not months and months later. So to start with, let's look at the bank statement. A monthly bank statement shows the bank's beginning balance. So what did the bank say was in the account on the first day of the month? It shows what deposits were made, what checks were paid and cleared the account in that month. And then there will be some other adjustments that are made by the bank. That may be interest paid, that may be bank fees, just depends upon the nature of what your account is. And then they'll provide an ending balance. In addition to the summary information that is represented here on this slide, most of your bank statements will also show a line-by-line representation of every transaction that flowed in and out of the bank account in the given month. This can sometimes be on a separate piece of paper, or it may just be a continuation of the same piece, the same page on the bank statement. However, all of this information will be represented in your bank statement. So, looking at the bank reconciliation objective. So, reconciling bank accounts in a timely manner. A bank reconciliation explains the difference between the cash that is reported on the bank statement and then what the cash balance is in the accounting records for the company. It also gives us additional information that we need for adjusting journal entries. We'll just take a second and let that slide populate. A bank reconciliation calculates an adjusted balance for both the bank statement and the company's cash account. The reconciliation begins with the balance per the bank statement as of the date of the statement, then adds the deposits in transit. These are deposits that are recorded in the company's cash account but weren't received by the bank as of the statement date. We then subtract outstanding checks. These are checks that have been drawn on the accounts by the depositor. So we wrote these checks, but they haven't made it to the bank for payment to be cleared. We add or subtract any bank errors that are discovered to ascertain what the adjusted bank statement balance is. We then do a reconciliation for the accounting cash account, and we begin with the balance per the company's cash account as of the date of the bank statement. We add deposits that are made by the bank. So this could be things like credit memos for interest earned on the account or cash payments received by the bank on our behalf. We subtract service charges for things such as non-sufficient funds checks, we add or subtract any book errors that may have been discovered. And then we now have our adjusted cash account balance. The adjusted bank statement balance should equal the adjusted account balance. So let's talk a little bit about what these differences are, because that's where things really can become a little gray. So the balances per the bank. The bank is going to record anything that is actually transferred through it during its operations for that statement cycle. What may have occurred is that you may have deposits for that last day of the month. On that last day of the month, you take those deposits to the bank. It's after 4 p.m. Those deposits won't post until the next business day. That can create a gap between what the accounting ledger says and what the bank says. That's a deposit in transit. So we've recognized the deposit in the accounting records on the last day of the month. We took it to the bank. We transferred it from our possession to the bank's possession. But the bank doesn't recognize it until the next business day, which is in the next month. You should be relatively familiar with the theory of outstanding checks. We write a check, we send it out. It needs to get to the recipient of the check, who needs to deposit it. They deposit it in their bank, and between their bank and our bank, they will present it for clearing, for payment. It's kind of a long process, especially if you take into account if it is mailed the U.S. postal system. So at the end of any given month, there is the high likelihood that there are some checks that were written in the course of that month that have yet to present to the bank to be paid in or cleared. This should help clear up a little bit of the gray, a little bit of the fuzz in relation to what some of these terms mean if you've not had any experience with them yet. So let's move a little farther forward in the bank reconciliation process and explanations. I've defined what a few of these terms are and illustrated how they happen when we're doing a balance per the book adjustment. So let's look at the bank reconciliation starting with the balance per the depositor and going to the adjusted balance. All reconciling items on your cash account book side require an adjusting entry to the cash account. So deposits by the bank where they've received amounts and you don't have them in your books are an increase to the cash account. You need to enter them into your books. Service charges you may have incurred are a decrease to your cash account. So you also need to enter those into your books. And then any book errors that may have occurred will result in either an increase or a decrease to the cash account. You have to record all of these different types of increases and decreases in the cash account into the general journal, which then you post to the actual cash account. So some things that may occur for book errors. This is a little bit more likely to happen in hand books where we're doing it the good old-fashioned way, less likely to happen with a fully automated computerized system. Can also happen when somebody just takes a blank check, handwrites it, and then reports the information that they wrote back to accounting. You have in your books that the check is $100. The check presented to the bank and cleared is actually $1,000. That is a book error. You need to make an entry into your books to account for the other $900 that check was. You need to correct the cash account. So to show you how this works, we're going to prepare a July 31st bank reconciliation statement and the resulting journal entries for Simmons Company. The July 31st bank statement indicates a cash balance of $9,610. Your cash ledger account, so your cash account per the books, on that date shows a balance of $7,430. The difference between the two, why is there a difference, needs to be reconciled. Through this reconciliation, we can find errors, we can find potential theft, we can find fraud, we can find all kinds of things that might happen. So what are the details? The details are that there are outstanding checks totaling $2,417. A $500 check mailed to the bank for deposit had not reached the bank at the statement date. The bank returned a customer's NSF check for $225, received as payment on an accounts receivable. The bank statement showed $30 in interest earned on the bank balance for the month of July. Check number 781 for supplies cleared the bank for $268, but was erroneously recorded in our books as $240. And a $468 deposit by Acme Company was erroneously credited to our account by the bank. So let's just take a second and look at these and how this may happen. So some companies are located far away from their banks, and they actually mail or FedEx their deposits to the bank to be processed. That shows where a $500 check may be mailed to the bank for the deposit that had not reached the bank at the statement date. You could also say a $500 check taken to the bank at 4:59 on the 31st had not been processed at the bank as of the statement date. Sometimes when a customer writes you a check That check is no good. When your bank presents it to theirs for payment, it comes back non-sufficient funds. They then your bank will reduce your deposit by the $225 that was assumed to be good and part of your account balance. You will receive, in most cases, some type of an additional notice when this occurs from your bank in the form of either an electronic mail through your banking portal or an actual piece of mail that will arrive at your business that talks about an NSF check and will show you the check that was returned. You now have to reverse the transaction because you did not actually receive $225 for that account receivable. There are many corporate accounts that pay interest on account balances. So you may earn interest on what is in your bank for the course of a month. And then, like I said, a lot of times if somebody takes a check and handwrites it and then reports back to accounting how much they paid on that check and what they purchased with it, if there's not source documentation attached to it, sometimes something can be erroneously entered. And then because the bank themselves are not perfect, there are times that they may actually deposit amounts into an account and it's not the correct account. I've actually had an instance where I deposited an amount, it showed up on 1 month's bank statement, and then the bank had reversed and removed it on the next month's bank statement because they lost my actual deposit, including the checks and the deposit slip, by the time it got to that bank's particular central operations. So since everything was lost en route, they removed that money from my account. I had to go back to my documentation in which I had copies of the checks, the deposit slip, and the receipts when we made the deposit into that business account to instigate and initiate the entire investigation for us to receive the appropriate funds back into our account. The reconciliation begins with the balance per the bank statement on July 31st of $9,610. Then adds a $500 deposit in transit. Subtracts the $486 bank error for the check erroneously deposited into our account. And subtracts $2,417 for the outstanding checks to determine the adjusted bank statement balance of $7,207. The reconciliation for the company's cash ledger account begins with the balance per that account as of July 31st of $7,430. Then we add the $30 of interest that was deposited by the bank because it has yet to be recorded in our books. We subtract the $28 book recording error for check number 781. Remember, there's $28 difference between what we recorded it as and what it cleared as. And then we subtract the $225 NSF check to determine an adjusted cash account balance of $7,207. The adjusted bank statement equals the adjusted cash account balance. The changes in the cash account then have to be recorded in the general ledger. The interest revenue increased the cash account by $30. The cash account is debited for $30 and the interest revenue account is credited for 30. Check number 781 error credited the supplies inventory account for $28 more than the credit should have been. And the NSF customer's check was returned by the bank, was initially recorded as a payment, and decreased the account balance by $225. The two initial entries must be reversed to adjust the cash account balance. The supplies inventory account must be debited for $28, and the accounts receivable account must be debited for $225, and then our cash credited for the $253 decrease in the account. Now, your book shows this in a very convoluted way with the combined effect. What you could also do is you could do two different entries. One would say supplies entry debit $28, cash credit $28, with a descriptive explanation of to correct check number 781, originally entered for X amount, was written for Y amount. And then the accounts receivable, you would do an accounts receivable debit for $225, credit to cash for $225, and then in the explanation and description, you would say check number whatever returned NSF from customer whoever it is. This provides enough detail that when we're going back, it is much easier to track and trace. So next, we're going to take a quick look at short-term marketable securities. Short-term marketable securities are current assets that include bonds, capital investments, and which are readily marketable. And they're almost, not quite as liquid as cash, but they're almost, meaning that we can sell them relatively quickly. There is little risk or variation in their market values versus the values that we are recognizing on the books. The next thing we're going to address in regards to current assets is accounts receivables, and one of the big drawbacks to extending credit. Accounts receivables are a necessary evil to doing business. So accounts receivables are reported on your balance sheet as current assets because they should be converting within the next year or the operating cycle, whichever is less. What they will have attached to them are what we call valuation accounts. Those valuation accounts are the difference between extending credit and what's really likely to happen. Whenever you give somebody a period of time in which to pay you, there is some risk that you will not receive the full amount in consideration. That is an uncollectible account. Some of the customers aren't going to pay. So what we do is we make a educated estimate on what that should be. This is going to be based on a variety of things: your recent collection experience, current state of economic affairs of the industry you're operating in, of the general economics of the country. It just depends upon everything that is going on. So this is not done by just anybody. Credit managers are typically the individuals that will engage in the estimates of what the probable bad debt expense is associated with a given period, which represents the amount of uncollectible accounts receivables that the organization should experience. We don't necessarily know who, but we can say based on a high amount of probability, X dollars won't be collected. What this valuation account that we call the allowance for bad debt expense does is it helps us pair or match the expense with the revenue that it generated, and then allows us to show a true and accurate representation of the value of the accounts receivable account on the balance sheet. At the end of each period, there should be a record that estimates the amount of uncollectible accounts. This estimate is typically an estimate of the amount of credit sales that are not going to be collected as a result of an increase to the bad debts expense, and then it results in an increase in the contra asset account allowance for bad debts. Keep in mind that the contract account allowance for bad debts is attached to the accounts receivable account and is a part of its valuation on the balance sheet to represent accounts receivables at net realizable value. There are two common methods for estimating bad debt. These are not the only methods, but these are the most common and mathematically calculable. That credit manager will take other things into account as he's working through this, but these are usually the basis of how they started off on ascertaining what their bad debt is. The first is the percentage of sales method. This is based on the collectability of all credit sales for a given period. The second is the aging of receivables method, which is based on an estimate of what the accounts receivable is at a given point in time. Both methods are recorded in the same manner. It's just how we arrive at what that expense is that differs. When we represent our accounts receivable, which is a current asset on the balance sheet, we represent it at what's called the net realizable value. That is, what is the amounts that are owed to you by others, less how much we realistically expect we're not going to collect. So, in all reality, how much are we going to collect? Now, reality is because we're not exactly sure when, where, what, so on and so forth. We don't know what customer or for what exact amount is going to default on an accounts receivable. When it is actually ascertained, when a customer actually is deemed as defaulting on the accounts receivable, it then is no longer an asset and we write it off. What we do is we take the amount from the allowance. We knew X dollars weren't going to be realized, and we clear off the account of the customer. So we debit our allowance for bad debts and credit the accounts receivable X customer specifically to bring that defaulting customer's account to zero and written off. It no longer has value to the organization at that point. So let's look at an example. On January 5th, KMAX determined that Jason Clark would not pay the $500 he owes. They have an allowance for bad debts, meaning they recognized over a period of time that a certain amount of money related to their portfolio of accounts receivable was not going to be collected. They didn't know which specific accounts that would be. So it's sitting in this generalized piggy bank. We create this entry. We take the amount of $500 from our allowance for bad debts, and we apply it to the accounts receivable for J. Clark. This will bring J. Clark's account to zero and be written off. Now, in good form, you would also make notations to that account so that individuals did not sell to J. Clark under any other credit extending situation within the organization. Now, let's assume some things about KMAX. Before this entry, their AR balance was $10,000. And the allowance for bad debt balance was $2,500. Because we represent accounts receivable on the balance sheet at net realizable value, what we really honestly expect to collect, then it had a balance sheet amount of $7,500. $10,000 less $2,500. When we actually write off an account, in this case, J. Clark's, notice that the net realizable value doesn't change. What does change is the representation of how much is in accounts receivable and how much is attributed to the allowance for bad debts. There is no effect on any of the income statement accounts when we write off an uncollectible AR when the allowance for bad debts is in play. Now, there's one other aspect in relation to accounts receivables that can be a bit of a hiccup when it comes to valuation. Some of you may have experienced this from the customer perspective. Some of you may have experience on this from the organization perspective if you work in a company's accounting office where there is accounts receivable. When we extend terms such as, for example, 2/10, net 30. What that means is that the customer can receive a 2% discount if they remit within 10 days. If not, then the full balance is due in 30 days. That discount period and that potential discount have an effect on valuation for accounts receivables. These cash discounts that we offer to our customers as a deduction from the invoice price are an inducement for customers to pay early, meaning that we can shorten our cash conversion cycle. Cash can then come back into the organization and we are more likely to be able to invest it and let it create additional revenues at a faster pace. So here we're showing you what that looks like when that term is at play. There will be a notation on the invoice and it'll look like this: 2/10, N/30, or it may say net 30. How you read that is the discount percentage, so 2%, The slash would be within the discount period, which is represented in days, within 10 days. The comma represents the word or. N is a representation of the word net, which is the invoice total. Slash within. And then the credit period in days, 30 days. Another issue another account in our current assets we want to talk about, because it can have an adjustment attached to it, is your notes receivables. Remember, notes receivables are more formal. They are an actual written promise to pay a specific amount of time at a specific future date. Most often, there is some type of an interest charge that's attached to it in the terms of the note. So we have lent money as an organization to somebody, and we said, we will provide you this at X% interest. That interest is the revenue that we generate by allowing them to borrow that money from us. They must pay us the face value or the amount that was loaned, plus whatever the interest is for that period of time that the money is borrowed. At the end of a specific period, an accounting period, we need to recognize any interest that has been earned but that we have not received yet as attached to accounts like notes receivable. Interest receivable will be debited. We'll be saying somebody owes us this amount of interest, but we have yet to receive it. And then we credit interest income for that amount, saying we have earned this amount in this period. You should have been exposed to the basic interest algorithm here. This is what we use to determine the amount of interest that was received. In the amount, the dollar of interest equals the amount of principal multiplied by the rate. So what is the interest rate multiplied by the time frame that you are calculating for? So for example, if you had $100,000 at 2% interest for 1 month, it would be 100,000 multiplied by 2% multiplied by 1 out of 12. That's your time, is 1 month out of 12, because interest is quoted in annual percentage rate. After you would calculate that, you would come up with the amount of interest that is owed to the organization and that was earned by allowing somebody to borrow that amount for this specific period of time. Your next most liquid asset is probably your inventory. Inventory accounts are absolutely classified as current assets, and they can include goods that are owned and held for sale to the customers. Now, for those of you that recall, we have a variety of different inventory accounts that may come into play. There's raw materials inventory, right? There is work in process inventory, finished goods inventory, and then of course things such as like merchandise inventory at a merchandising organization. With inventory, there are two different types of inventory systems. There is what we call the perpetual inventory system. This should be reviewed because you have covered this information before. In the perpetual inventory system, inventory purchases and sales are recorded as in this manner. Purchases increase the inventory account and increase accounts payable or cash, and increase accounts payable or decrease cash, my apologies, depending on the situation at the point of the transaction. Sales will increase the cost of goods sold account and will decrease the inventory account. Cost of goods sold is represented as an expense attached to the sales revenue. In the perpetual system, this happens on the purchase date and on the sale date. We are constantly updating the records. It is perpetual. The perpetual system is one that you're going to find is more at play now than it ever was before. This is because technology has come in and they have allowed us to be able to do this more efficiently and more rapidly. The perpetual inventory system provides much better inventory records and a much swifter determination of the financial statements than the periodic system, which was the one used for hundreds of years. Additionally, attached to inventory. So how do we know what's going to flow over to cost of goods sold? We have 8,000 pens. They all look the same. But when we purchased them as our inventory, they had slightly different amounts associated with them. How do we ascertain what's going to flow to cost of goods sold? For that, we have to use an inventory cost flow assumption. With your inventory cost flow assumption, there are 4 inventory cost flow assumptions: the specific identification method, the weighted average method, FIFO, which stands for first in, first out, and LIFO, which stands for last in, first out. We're going to look at some of these here in just a moment. But there are a couple of things I want you to know before we dig a little bit deeper into inventory cost flow assumptions. And that is that although a company chooses FIFO, that doesn't mean that they have to use FIFO for every single piece of inventory they have. They decide to begin carrying a new line at a later date. They may then choose LIFO for that specific line. Also, a company does not have to continue to use, say, weighted average. They chose weighted average. They've been using it for decades. There may be economical and justifiable reasons for them to switch to another inventory cost flow assumption. They can do that. However, it is important that when you switch an accounting principle that you use, that you disclose that and its impacts in the notes to the financial statements. So we're going to look at the bike company. And their inventory consists of beginning inventory as of August 1st. So they had 10 units at $91 on August 1st. They had 3 purchases on August 3rd, August 17th, and August 28th, bringing them to a total number of 55 units. They also had 2 sales on August 14th and August 31st, representing a total of 43 units that were sold. This is the basic information that we're going to be using, looking here as we go forward. So with specific identification, when a unit is sold, the specific cost of the unit sold is added to the cost of goods sold. This works really well for very large items, things that have identifier numbers attached to them, luxury goods, diamonds, cars, furs, things of that nature. It does not work well for anything that is mass produced. So 8,000 pens really cannot specifically identify which pen we sold. Specific identification is one of the least frequent inventory cost flow assumptions that is used because it does require the ability to specifically identify the item at the point of sale. Weighted average. For weighted average, we calculate the average cost of the items in beginning inventory, plus purchases made during the year, the period. The calculation is cost of goods available for sale during the year, divided by the total units available for sale during the year. And this gives us a value that we assign to all of the sales for that period. So let's illustrate that using the beginning balance and the purchases for the bike company. So looking at their August inventory, the total number of units available was 55. It's comprised of the first 10 units that were there at the beginning of the month, and then the purchases on August 3rd, August 17th, and August 28th. We extend each of those purchases out to what they were after at the point of receipt. So August 3rd, we purchased 15 units at $106. That purchase was $1,590. We applied this to all the purchases, combine it to the beginning inventory value for a total of $5,990. We divide that by the total amount of units that were available for that given period, or 55. And then that gives us a weighted average cost per unit of $108, well, 108.9091. If we are using a periodic inventory system, so we're truing it up at the end of the month, then we would take the 43 units that were sold and multiply that by the 108.9091 cost per unit. The ending inventory is calculated by multiplying the amount of units left in the ending inventory by that weighted average of 108.9091, or $1,306.91 in ending inventory. August's ending inventory then becomes September's beginning inventory. Using the first in, first out method, what we do is we assign the oldest costs to the cost of goods sold and assume that recent costs are what are comprising our ending inventory at a given point in time. This does, in most cases, reflect the physical flow of inventory through an organization. Because managerially, you are trying to get your older items out faster. You want them gone before the newer items. Anybody that has worked in any type of food service industry or grocery understands, or retail understands the term facing, meaning pulling the older things up to the front and then stocking behind them. This is how we expect the physical flow of inventory to actually move through an organization, logistically. So to illustrate the first in, first out method, and we're illustrating it underneath the periodic system rather than the perpetual, because underneath the periodic system, we have to calculate what we expect our cost of goods sold to be. We have to calculate our ending inventory. So looking at first in, first out, the August sales for TBC would result in the beginning inventory and the first purchase as costs assigned to cost of goods sold, and the last purchases costs would be assigned to the ending inventory. So using the periodic inventory system and the 43 items sold, we would allocate those costs. We would assume cost flow assumption to the first 10 items of the beginning inventory at $91, the next 15 at $106, the next 18 at $115. This will provide a total cost of $4,570. We then make the assumption that the ending inventory is going to be comprised of the 2 remaining items from the August 17th purchase, and then the 10 items from the August 28th purchase, or $1,420. Conversely, from first in, first out is last in, first out, which assigns recent costs to cost of goods sold and the oldest costs to ending inventory. Still using the bike company or TBC to represent this, and their August sales, we would have a result of, in the last purchase costs assigned to the cost of goods sold, and then the beginning inventory and the first purchase costs would be ending inventory. We're assuming the last in is the first out. Using the periodic inventory system, the 43 items sold would be assigned 10 at 119 for the August 28th transaction, 20 at 115 for the August 17th, and then the remaining 13 would be at 106 from the August 3rd transaction, for a cost of goods sold of $4,868. The remaining 12 items would be comprised of the 10 that were in beginning inventory at 91, and then the remaining 2 from August 3rd at 106, for a total ending inventory of $1,122. Now, what happens over time is that your costs change. What you are paying for your inventory changes. This can be as a result of something in the industry, could be a shortage in one of the raw materials and making the goods that you are purchasing, could be due to general economic fluctuations. In periods of rising costs, so what I'm going to pay for at the end of the month is higher than what I'm going to pay for at the beginning of the month. Usually not necessarily that short a period of time, but just to illustrate. In periods of rising costs, LIFO, so last in, first out, results in a lower ending inventory and a higher cost of goods sold than first in, first out. Changes in the quantity of inventory have an impact on profits and are dependent on the cost flow assumption that is used and the extent of what those cost changes are during a given year. Costs are not stagnant. They do not remain the same over all the time in reality. So depending on the inventory system used and the cost flow assumptions, things can be different. There are two accounting inventory systems. The periodic, which is at the end of a period, we determine what the cost of goods sold is. This goes back to all the years of not having computer systems that track everything for us. We would go out and actually count the inventory and recognize what items of what inventory there were, and then back into our cost of goods sold. Then there's our perpetual inventory. This means every time inventory is sold, it's recorded. There are the different types of inventory accounts I talked about at the beginning. For retail firms is merchandise inventory. That's all they have because they are a middleman. They acquire goods and then provide them for sale to the consumer. They don't create goods, so they only have merchandise inventory. They may have hundreds of thousands of items of merchandise inventory, but it's merchandise inventory. Whereas at a manufacturing firm, there may be a variety of inventories. They should have 3 specific types. Raw materials, this is when they purchase all the things that they need in order to make whatever it is that they're creating. They would have work in process inventory, which means that effort has been put into effort has been put into converting raw materials into a finished good, but it is not yet completed. We have invested X amount of materials, X amount of overhead, and X amount of wages and labor to this. And then finished goods inventory, which is the inventory that's ready to be transferred. It requires no additional effort to convert it. With inventory, of course, there's a potential for errors. Errors in the amount of ending inventory have an actual dollar-to-dollar effect on things like our cost of goods sold and our net income. Because of this, when the independent auditors, income tax auditors, and financial analysts are looking at reports or they're coming in to do an actual audit, they look very closely at inventory amounts because there is such a huge dollar-for-dollar impact when an error is in play. Inventory errors or inventory fraud are one of the ways in which some organizations have perpetuated large-scale scandal over consecutive years. One thing that occurs regardless of the cost flow assumption that is in place is that inventory has to be reported at market value when the market is lower than cost. So this is called the lower market or cost. Market is defined as current replacement cost, not what you can sell it for, what can you replace it for, and is consistent with the conservatism principle. It can be applied either separately to every item of inventory, so every different type of item you carry, or it can be applied to broad categories of inventories. So, for example, think about Walmart, and they have a lot of items. So maybe instead of looking at it as, okay, apples, shampoo, dog food, and each individual item, maybe they do instead produce, frozen foods, canned foods, health and beauty, clothing, sporting goods, pet supplies, more broad categories, or it can just be overall applied to the inventory as a whole. The next asset that we want to talk about is prepaid expenses. So these are expenses that we paid out money for in the current fiscal period, but we have not used all of whatever it is. It will continue to cover us into another period. We have some prepaid expenses that require regular adjusting entries. And when that occurs, the assets decrease and the expenses are increased. Common examples are insurance and rent. So we pay for a 1-year insurance policy on January 1st. That policy is covering us for a year. Although we laid out $1,200 in cash, it does not all apply to the month of January. It applies to January, February, March, April, so on and so forth. So what we do is we recognize it on January 1st as an asset, showing that our insurance company owes us coverage for a period of time in the amount of premiums equal to $1,200. As time surpasses, as we consume that coverage, as it expires, we recognize it as an expense. We increase our expenses and decrease our assets proportionally. The next current asset that we'll talk about is a deferred tax asset. This arises when an income tax is recognized for financial accounting purposes in a fiscal year before the actual fiscal year in which it is deductible in the determination of taxable income. This is kind of a convoluted topic and not one we'll go into great depth at this time, but so you can recognize what a deferred tax asset is if it is represented on the financial statements of the organizations that you are reviewing. Be aware that this is what it is.